Right, cool, great stuff. So, I think there used to be, again, to give context to this, there used to be this history where I remember when I was training, we used to keep a statement of financial position for, like rental. When I say rental business, no, I wouldn't even say rental businesses. You would have this person who had a flat, and we would capitalize their assets, and you'd buy a washing machine and a couple of things, we'd capitalize it, and prepare an income statement. We almost prepared like both statements. And again, like I say, there's all this debate about the capital allowances to do with this and if they got any. And so HMRC have just simplified everything, and literally just wish under the cash basis to treat. I think it's important to treat a lot of these so-called capital expenses as just normal revenue expenditure. Now, the caveat to that, of course, is that in the context of, say, tools and things used for maintenance in the looking after, this is all the growth of this buy to let, looking after the business, actual looking after the business in the day-to-day maintenance of the business. That's fine. You can put everything through as a general expense, allowable deduction. Now, of course, if you now buy a car to run your business, because we're not quite keeping a balance sheet anymore, you can't put through the car as an expense, most definitely not. And typically, if you buy assets, again, like if you have a fully furnished buy-to-let property, you can't put those assets because that's all capital, right? You can't put those assets in there as normal expenses. So furniture, washing machine, no, you cannot. You cannot. But I'll come, and that's the big but. What you can do is that after you put them in there, if after a year or two you want to replace them at the same value, so you're not like upgrading them per se, you're just, so think of it as maintenance. You're just replacing them, then you can put through that replacement cost of replacing a washing machine, the replacement cost of replacing a sink, the replacement cost of replacing. You think of it more as a replacement cost, as a repair, and just keeping it at its usual standard value. You're not setting it up for the first time. So it's still following very much the rule of the distinction between what is repair and what is capital. Repair maintains, capital enhances. So we're not enhancing by replacing a sink or replacing a washing machine. We're just maintaining. So, and therefore, repair expenditure therefore becomes allowable, and improvement expenditure is not allowable. So that's kind of the point to see there. So of course, if you have a car and you're driving in, from one property to the other, maintaining, what is allowable and is as an expense is, if you like, what is the standard allowable petrol expense, which is typically your mileage times what the government consider to be the mileage allowance. And we'll see that later on in greater depth, but it is 45p per mile up to 10,000 miles. So you can put through 45p per mile of all the miles you're moving around to try and deal with the expenses relating to this property. And so again, this is HMRC approved. Of course, you will see this over and over again. Very popular if you're using your own car for work and you're going from place to place. You're allowed 45p the first 10,000 miles. In this case, you are definitely, because when we come to talk about later on, when we look closer at employment income, your employers might be giving you something towards your travels, and so you'd have to deduct that to see what the net benefit is. But in this case, this isn't the case. You're actually just going around managing this property, and so there we are. So this is what I was talking about earlier on. This question of replacement of domestic items. It's really more repairs and maintenance of these costs of these assets. Then that's why they're considered that way. Again, replacement means that you're replacing it. It's limited to the cost of a similar item. So we're trying to prevent the question of improvement. If you end up in that scenario, you'll end up probably having to, well, you can't recognize the full amount. You would have to disallow anything that's much more expensive than the same value. I imagine within reason, but the question keeps it simple. But in reality, I imagine that if it's of the same standard, the full amount can be put through, even though it's a bit more expensive, if that makes any sense. But who knows? The fact is that because these things are being, it's all about demand and supply, and I guess it's really what the price is at the end of that period. So here's a nice example here to illustrate this. Giles owns a cottage out furnished at an annual rent of 3,600. Now remember, like I said, everything's on a cash basis unless you're specifically told to perform this on a accruals basis. So yes, the annual rent is 3,600, but that we need to be careful to see what rent did he actually receive. So replacement bedroom curtains, that's fine. We're replacing a broken kitchen sink, that's fine. Insurance for the year, 5th of July. Yes, it was 420. Yes, it's 480, but we're not accruing. We're not doing any chopping and changing. That's what we put through, the 480. Dishwasher brand new. No, that can't be put through as an expense. You can create a balance sheet if you want to capitalize it, but the whole thing just becomes a bit, it's not a business, if you like. And so, because it's not a business, you're going to have to think about dealing with the sort of depreciation and all that fancy stuff, but we're not doing that. This is a cash basis type approach. Redecoration, and that is, if you like, yes, the redecoration is a repair, and that should be considered. But when you look at the date, you see that this happened in May, so this happened after the 5th of April. So therefore, it will not show in our year. It'll simply show in the next year because that's when we paid it. Right. Although it was completed in our year, but it was paid in May 2020. So it says here that the tenant had left during June 2019 and not paid for June. He was unable to trace the tenant, but he rented it again from the 1st of July. So there's 1 month of rent not missing. So taking out 1 month of rent out of there, divide that by 12, and then multiply it by 11 to get the actual rent for the year. Security is not rental income. Security is a bond, so it's not, we can't consider security as rental income, no. And yeah, and then of course he says he drove 120 miles, so he gets 120 times 45p, allowable expense. And that's what you see here, 3,300. Those replacements were fine. That's the mileage allowance. Dishwasher, capital no, and redecoration, of course, it's coming out in the following year, and that's how we deal with those. So what is the moral of this story here? The moral of the story is that we are only looking at expenses that are wholly and exclusively for the business. 1. 2, they must be in the period. 3, we will allow replacement costs because we are not enhancing, we're simply replacing. 4, any assets bought for the first time are not recognized, they are capital, so we cannot be putting through them as an expense. Tools for the business, maintenance day to day, yes, that's fine, put through as an expense. Mileage, use the annual mileage sort of allowances given by the government to calculate any driving expenses, if you like, and use those as expenses. Cars, no, you just there's no sense in that. You can't even think about that. That doesn't make any sense. And this again, the focus here is to do with you having a property that you have, or I guess we're going into the general buy-to-lets. You have not registered as a business. You're not really considering yourself as a business. You're just, if you like, having a bit of property income, where you have a sitting tenant for most of the year in there. And you'll see why this matters, because this is very different to, say, for example, having you might have noticed it, having these definitely this happened to me before, where you have these furnished holiday lettings or similar type things where people will live there for the week and return back to their homes at the weekend, but they'd have to find a different one because the landlord is saying, I can't have you in here for too long because this is a business. I treat this as a business, and so the rules are different, as opposed to you just taking out a long lease on a flat for a year. So there is a difference there in the approach to how these incomes are considered or what they can be used for. This is purely property income subject to tax at 20% and 40% and 45% once we've netted off all the expenses. Cool, great stuff. Please do this TYU. Definitely, that's a help. That's always a good one to do, please. And again, just highlighting this idea here that unless you're told to do so in the question, we do not use the accruals basis. If you're using the accruals basis, it literally is what it is, the accruals basis. I would have accrued for rent of 3,600 and put through expense not received for a year, taking that off. So in the end, I'd still be showing 3,300, but I would show the if the recoverable debt would be considered an impairment loss. You can think of it that way. So the net figure would still be 3,300, as in that other question we just did. And the here, of course, the other main difference is that expenditure on plant and machinery and tools used for maintenance is not an allowable deduction for income, and capital allowances would be allowed instead. So we would have to create, under accruals, we would have to create the whole statement of financial position, create your assets, start having capital allowances, and all of that. So again, like I said, when I was studying, that was the only option. We only had the accrual option, and we almost had to do that. But now, because of the cash basis, we can avoid all of that. And just if we use the cash basis, we just don't recognize those assets anywhere. It's just trying to put everything through the cash basis. I guess, of course, at work you will still have to decide what methods are best or best favor the client. And of course, the restrictions of 75% of finance costs remain in place, very much in place. Cool, great stuff. And business losses, yes. So for example, what we're doing here, it's actually really nice and simple. This what you do here. It's very possible that you might have made losses on some of your property if you have one or two. If you have a number of properties and you make losses on one or two of them, we basically add everything together to find out what the net property income is. Think of it that way. So we're literally just saying, like, if you look at this question here, we're saying here, okay, what happened here? You had some income in 2018 on your three properties here, 1, 2, 450, 3, 150, and those are all your expenses. And this is the same thing. So we're literally adding across everything here and taking away everything here and finding out what your net situation is. As in the same thing here, adding everything here and taking off everything here. And that's what you see us doing here. So here in this scenario here, you had property income of nothing. So you're not going to recognize any property income in your calculation. Nothing at all. You just have this loss that you can carry forward. This is important. You're not going to recognize because you didn't have any income. You just had a loss. In the following year, what you now have is you now have all your income and you now have all your expenses, and you now have income here of 550. And then you now carry forward that loss of 450 against that. So in a way, you almost have to keep a nice record of your property income and your property losses. So you can see I couldn't suddenly go up to my tax computation and say, oh, employment income X, property loss, take it off. No. If you've made a loss, you hold. You wait and you move that into the next year to offset any income. And then you now recognize the net income of the next year that you've just offset. So for example, in this question, property income will be 100 in 2019-20. So that's how we relieve our property losses as individuals just trading and just getting on with just individuals going to work and dealing with it on a day-to-day, just dealing with having a flat or two. And so that's how we deal with the property losses and the property income. Okay, great stuff. That's the end of that video, and we will move on to the next bit in the next video on leases.